Hey everybody, CJ Maurer here, back with another episode of PeopleWork, where we talk to experts in various fields of human capital management to talk about how to run a business and how to manage a workforce most effectively. And today I'm really excited to be joined by a CPA named Brett Neal out in Central California near Fresno. What's really cool about Brett is, as maybe some of you know, that here at Complete Payroll, we are really big on sharing content and educating people proactively about payroll, HR, labor laws, or anything that relates to human capital management. Brett and I actually connected on Twitter. He had been following us, noticing some of the content that we had put out there. We started engaging and talking, and we've been really impressed with Brett's initiative to be a content leader in his field of accounting as well. And so we connected, and we decided it'd be a really good idea to talk about one of the most important and yet overlooked tax issues that a lot of employers face. And so he's gonna help you guys out in the next couple of minutes here. But first of all, Brett, I just want to say thanks for coming on.
Hey CJ, thanks for having me. It's a pleasure to be on this show. I think, gosh, it's been a while. We touched base on this probably like 6 months ago. I think that was one of the first time I had seen one of the posts from your company, and it had to do with New York taxes, New York City taxes. And we have a client in New York City. We deal with payroll with them. And I went and I watched your blog and watched the video. And then I think I made a comment on Twitter like, hey, check these people out. They have some good information. And it started from there.
Yeah, we appreciate that. That's the perfect reason why we do it. So, kudos to you for taking advantage of that. But now the tables are going to turn, because where we are often the content leader or the topic educator, now it's your turn, right? And so Brett is here. He's going to talk about reasonable compensation.
Reasonable compensation.
Yeah, just got through some New York labor law stuff with employees where we were talking about reasonable accommodation. We're talking about reasonable compensation. So Brett, for all of the business owners out there, what is reasonable compensation and why should it matter to them?
Yeah, so reasonable compensation is defined in the Internal Revenue Code as basically reasonable for services actually rendered. And who is this important to? It's important to S Corp shareholders and C Corp shareholders. More specifically, owners that are also shareholders in those companies. If you're an employee to your company, you're going to be expected to take some fair wage, a reasonable wage, and that's really where this comes from.
So how does a business owner or the IRS or anybody determine what a reasonable wage is?
Yeah, so that's going to be the hardest part, and we're kind of going to talk about it as we go through some of our discussion points. And basically, I mean, it's not defined, but what we're going to look at is a fair market value. I mean, if I were to answer the question specifically, it's what would you be paid if you worked in a similar position in a similar company doing similar things? So you own a company, you're a shareholder, you're the one really making your company go. But if you turn that around and you held that position in a different company, what would they pay you? And that's going to be a good starting spot for your reasonable wage.
Okay, so why does it affect S Corps and C Corps more than other legal entities?
So specifically what we're looking at is like closely held corporations or family corporations, not family corporations, but closely held family businesses. Shareholders that are employees that don't take reasonable wage in an S corporation are effectively avoiding self-employment taxes. And the government frowns, obviously, on that kind of maneuver. And it's not necessarily understood. You may not even be doing it intentionally. But what could happen is the IRS could come back and reclassify maybe some of your distributions as wages. And then you're going to be expected to refile tax returns, payroll tax returns, maybe have penalties. And it's just a trouble that you want to avoid from the beginning.
So to be clear, just to make sure that I'm understanding this, and I would guess that this would be the case, right? But I would rather have you confirm. The biggest issue when it comes to reasonable accommodation is that business owners try to limit how much they take from the company as employee wages to minimize their tax liability, correct?
Right, exactly. And in S corporation, if we flow through income on a K-1, then that's not subject to self-employment tax. So if I minimize my wage, then I'm going to flow through more net income on a K-1 and not pay self-employment tax.
Got it. So you talked about some of the consequences if the IRS goes back and catches you and reclassifies some of your cash flow as wages. There could be penalties. I guess not just the penalties, but overall, talk about what are the consequences of not doing this the right way.
Yeah, I laugh because what comes up in discussion is Social Security. Will there be a Social Security for the rest of us when we're ready to retire, right? And I kind of almost feel like this is what the IRS is chasing on your behalf. And it basically comes down to don't mess with the trust fund. So when we pay our Social Security and our Medicare taxes, it essentially goes into one big bank account that the IRS and Social Security distribute, right, for Social Security, Medicare on our behalf. And to be sure that it's funded, we have to make sure that employers are paying their fair share as well as employees. And so businesses have to collect it and then submit on a quarterly basis. You know, as a payroll company, you guys know that kind of stuff. But the penalty is if you get in trouble, that's kind of like the big caveat, the trust fund penalty. They use that account to say, hey, look, if you've touched this or messed with it in any way, we're coming after you. We're going to kind of figure out like what went wrong with your business. We're going to assess the penalties. The additional issues are having to amend payroll tax returns, and this could go back 3-4 years. So if you start talking about amending quarterly payroll returns, your business tax return, and having wages, you're also going to be amending your individual income tax returns, and you're going to have fines and penalties at every level.
So how does the IRS figure this out?
Yeah. So where are they looking? They're obviously going to be looking at business returns, specifically S corporations and C corporations that are closely held. So one shareholder, two shareholders, maybe people that own more than 50% that are also employees within those corporations. But they're also going to look at an individual's tax return as well. If you have a Schedule E, a K-1 being flowed through to your individual return, then you probably have a Schedule E on your income tax return, and you would see that income be reported on line 17. So if I was an IRS agent, I could see that there's income on line 17, and there is no income on line 7, and that's wages. So that's going to be an alert for me. And then so go ahead.
So that's effectively an alert that the IRS sees that you are claiming wages on your personal tax return, but not paying yourself wages on your business tax return.
Well, what they're going to see is that, right, if there's no wages on your individual income tax return, but there is the wage, right, but there's the net income flowing through from your business, that's going to be the quick comparison on your individual return.
Yeah, so I imagine this is something that probably isn't terribly complicated for them to flag.
Yeah, I don't think so. And then the next level is just looking at the business return. Because I see the association on your individual return, I can go straight to your business return, and I can see owner's compensation versus net income, maybe versus dividends or distributions. And It's easy to make a comparison.
So if you are, let's suppose that you are the owner of an S Corp or a C Corp, and you're thinking to yourself, well, this sounds like something that maybe I could be flagged for, or sounds like something that I could be doing right now, and I want to kind of get out ahead of this and resolve this. What advice would you have for them?
Yeah, especially since it's year end. Hopefully you're on top of your books. You have clean books and records, and you have an idea of what your net profit is for the year. And if you were to make a projection, you only have to make a projection out for the last quarter, the last 3 months. But a good rule of thumb, and this is something the IRS is looking at as well, is a 1-to-1 ratio. Basically, does my compensation equal my net income in my business? So if I have a business that nets $150,000 of income and I have 0 wages, obviously there's a flag there. So easily right now is I could just say, hey, let's pay myself half that, $75,000. Now my $75,000 in wages equals my $75,000 in net income. At least I'm making an attempt. We haven't defined reasonable compensation, but at least you're making an attempt, and you're reducing yourself for an audit.
So you talk about the 1-to-1 ratio, right? But what if earlier you mentioned fair market value? So what if the 1-to-1 ratio, applying that, does not give your salary a fair market value? What happens?
Yeah, that's going to be a good question. So fact and circumstance, what's your position in that company? How much effort are you really putting forth? Traditional service-based companies, if you're the sole shareholder, you're also pretty much the worker. You're the one doing all the work that makes the income for the business. If you don't have employees or something like that, you're really not leveraging yourself. So there could be an argument made that almost 100% of the income should be wages. Vice versa, if you have a workforce or a staff, 1, 2, 3, 10 employees, you become leveraged, and the inputs from the company aren't as much from you as they are from the team. So then you could begin to argue that your reasonable wage is not going to be as much. Where fair market value comes into play is basically looking outside the box, comparing yourself to others. You have to look at your competitors, maybe go to a resource, find a guide, and what's the proper wage within that market.
So looking at your competitors, what about within your own company? I would imagine a lot of business owners might choose to pay themselves less than other key employees in the business. Does that ever run into an issue where traditionally you might assume that, C-suite or a CEO might make more than the rest of the employees, or at least C-level employees might make more than managers and directors and other specialists within the company? Is that ever an issue?
Yeah, I mean, I think actually that's if you're going that route, you probably are writing that stuff out in your corporate minutes, and you're probably talking about it amongst your team. So if you have good notes and substantiation for the reasons you've chosen the salaries, that's going to add to your benefit. But again, if you're paying people, like you say, your executive employees and yourself, and you're making the attempts, I mean, at the very least, you're keeping yourself away from an audit, right? You're trying to do it right.
And that's really what this all comes down to, right? You want to take the necessary steps to prevent getting audited.
Yeah, I mean, you don't want to break the rules specifically, like explicitly, right? When you know you're just doing it wrong. And then exactly, why not do what you can to avoid the audit, or at least avoid the pain if they do come through, and recharacterize some of the distributions or some of the wages.
Does the IRS operate with any leniency when they can perhaps tell the difference between an honest mistake, some type of error, minor oversight, compared to, basically chronic and strategic tax evasion?
Gosh, I wouldn't say the IRS puts any kind of probably if you're going to compare it to a straight up tax evasion, but I kind of don't go with leniency in that manner. I would say more professionalism, honesty, and integrity in answering the questions, right? If you're going to be during the audit, it sounds like, I mean, just be appeasing, have good information. If you're going to be kind of, I don't want to work with the IRS, and I don't know why you guys are in my stuff, it's going to be a bad audit.
Okay.
And it's more about relationship, I think, at that point.
I can understand that. So what would you say to, what advice might you have for, and you maybe kind of already answered this, but I want to ask it in a little bit of a different way. If you had a new client and that client is the owner of an S Corp, my first question is, how would you be able to identify if they are not paying themselves reasonable compensation? And if that is the case, how would you advise them to fix it?
Yeah, so got to protect myself too, but the taking on a new client is really having that introduction, all those questions. Who are you? What are you guys doing? What's the basis of your business? Where are you heading with it? What's the reason for this existence? Why did you choose me? What's the pain point that I can serve for you? And really kind of getting that foundation to see if it's a trustworthy client. Because then we're going to have that next question is, I see that you don't or do have wages. How did they get determined? And what's your long-term planning? There's going to be a lot of new businesses that really don't want to take money out of the business because they want to reinvest it in the company, right? And that can be fair, and that might just be something you need to substantiate. Not saying don't pay yourself just because you want to leave it in the company. That might have to be in your minutes or something like that to kind of discuss its deferred compensation. And then what we do is I kind of have a 3 strikes and you're out. Hey, we talked about it. Sometimes you get clients late in the year, or sometimes you get clients right before filing season, and you just kind of got to do what they did and just file that return and just let them know, hey, it's not 100% right. This could come back to you. Let's try to do it right next year. If you're in the same position a year or 2 out, again, we kind of have our 3 strikes you're out rule. I've put it in the letter. I've talked to you about it. I feel like I can't help you on this, or you don't want to do it right. I don't know if we're a good fit anymore.
Yeah, that makes sense. That absolutely makes sense.
It's tough. It's tough because we just want to help. You know, you really want help. You see people doing it and think, oh, this is an easy fix. But
yeah, and you know, Complete Payroll as a payroll processing provider, we kind of run into that sometimes too, because on one hand, right, we pay their people, we advise them on labor law. For example, you are paying manual laborers, therefore, according to labor law, they must be paid weekly, as an example.
right.
So we can tell our clients what the labor law says and what the legalities are, but physically we are, as a mechanical processor, we are unable to force them, right?
You can't hold their hand.
So, right. So some, you know, we do run into that sometimes, and your situation is a little different, but I understand that. Tell me, what happens if like cash flow is an issue? If cash flow is preventing them from, these business owners of S corps or C corps, from paying themselves reasonable compensation?
Yeah, so I just think what you kind of want to do is maybe just take advantage of the situation. Not all wages has to be, not all compensation has to come from wages. If you're an S corp owner and you have income flowing through in the company, you're gonna have taxes on your individual income tax return. So I think one of the best ways to kind of double dip is use payroll to pay your taxes that you owe at the end of the year, and let the money let that cash only be the taxes. Don't pay yourself a wage and also pay your personal withholding tax and your state withholding tax. Just make that your wage. That way you're maximizing your cash flow, and you're paying your taxes through your S corporation. That's one trick.
Interesting. Well, Brett, what did we not talk about that maybe you were hoping to discuss today as it relates to reasonable compensation?
Yeah, I mean, just a couple things to think about. We talked about who it is. S corporations, really going to look at more than 2% shareholders. We talked about 50% and 75%. Just the truth is, you're usually 100% owner, or you're really just in a small partnership. There can only be 100 shareholders, so your chances of being more than 2% shareholder is likely. So that puts you in that position. Yeah, I mean, cash flow, maximizing. You know, if you're against payroll for certain reasons, don't forget it's not just funding self-employment tax, but it also opens up your opportunity to fund a 401k, because you have to have wages sometimes to fulfill your 401k. And not all wages are compensation. Kind of brought that up, but maybe think about your auto inclusion rate if you're in a C corporation, and think about medical insurance premiums. Those are included as well.
Okay, before I invite you to give anybody watching this a way to get in touch with you, do you have any parting advice for business owners as it relates to reasonable compensation, or anything related to this topic?
You know, I think, like I say, just take a look. Hopefully you're invested in your financials, so you should be taking a look at that stuff pretty often. And just ask yourself that question: am I being fair? Am I being reasonable about what's going on in my company? And I mean, I think that's just the biggest point to drive home, is just ask that question about fairness.
Well, Brett, I think this is really great, and I thank you so much for joining us to talk about an issue that undoubtedly impacts a lot of business owners in New York State and around the country, especially where you are in California. So I really appreciate you shining a lot of light on this topic. For those that might be interested in getting in touch with you, how would you direct them?
Yeah, I mean, the easy way is hit me up on Twitter at Brett Neal CPA, or you can also email me if you like, Brett at brettnealcpa.com. Thanks, CJ. Yeah, that was awesome. A lot of fun talking with you. Thank you.
Yeah, I hope to do it again soon. Take care.
Take care.